Hey guys, we have a problem today. The price of my baguette has went up. It almost doubled. It's not only my baguette, it's the price of any baguette. So this piece of bread you can see here in the place where I live, just above Monte Carlo in the French Riviera, went from 90 cents to €1.80. So basically it doubled. So it's not only a problem I'm having, it's a problem that everybody is facing, and it is inflation. Okay, so today we're gonna talk about inflation. Before we get started, I just want to remind you that I'm not a financial advisor. I'm just here to create video content for the mighty Savius. The idea is to generate interest, discussion, and maybe entice you to study more. But as far as your trading is concerned, you should be doing your own research and take your own decisions. Okay, now that we said the mantra, we can move on and try to understand what is going on here. So basically, apart from what the boulanger is trying to tell us, is mostly a magic and a standard rule in economics that in order for price to move, we need an imbalance between demand and supply. So in this particular reason, we have this particular moment, do we have to focus on demand or on the supply side of things? What happened there? What is this really linked to the war in Ukraine only? So basically, our prices going up because we're eating more bread, or because maybe we have some disruptions in the supply chain, which could be exactly as we said, due to the war in Ukraine. I guess the reason is a bit, it goes a bit, it's a bit more complex than that. Let's say that in general, demand for things, for not only for bread in general, but for raw materials and finished goods, it went up. So prices in general of everything are going up because these prices have been pumped up. How are these prices being pumped up artificially? Well, when we talk about macroeconomics, these are means that can be only led by and decided by, of course, government and central banks. So how do we actually increase prices? By allowing those who consume, the consumers, to spend more. How do we do that? How do central banks do this? They achieve it by putting more money in their pocket. So typically, where do we go and find money when we want to buy a new house, when we want to buy a new car, when we want to purchase a new motorbike and try to pay it in several installments? Well, we go and ask banks. So what do banks do is basically they lend us money, and they do themselves get this money partly from the clients of the bank, of which they are obliged to maintain a fraction as a reserve before, and then they can lend out another fraction. And of course, they can borrow money for the central banks, and then of course lend them back to the consumers. So what they do, they profit between the spread in interest rates, short-term interest rates, the interest rates at which they finance themselves, long-term interest rates, which is the rate at which most likely they will lend money to their clients. So if these interest rates are low, they can finance themselves at very cheap rates, and they're more keen to, of course, provide money to us, to the consumers, or to companies. And that is, by the way, one of the big differences in I would say, in the from the American United States economy towards the European economy. In the United States, companies are able, it's much more easier for those companies, for especially stock listed, to raise capital, either by, of course, accessing the stock market, or by they issuing their own bonds and getting, finance directly from the public. In Europe, it looks like the average size of the company is medium to small size company, and for this sort of companies is much more difficult to access those markets, so they need to rely a lot more on banks. So that is why what we observed during the past years is that each time we go to an economic crisis, and central banks in the US and in Europe, they sort of use the same mechanism, so the interest rate mostly, and then of course the other one, which is the quantitative easing, which we're gonna discuss of in the next part. This economic measure, they impact the American economy much faster and much better than they do in Europe. In Europe, we had the feeling that banks do receive these incentives, but these incentives not always reach appropriately the companies or the man on the street. Okay, so basically, let's go back. So we have low interest rates, money is circulating, prices go up. We want to use this measure mostly as to relieve economy, because they have a certain series of benefits for the economy. First of all, is increasing inflation, because inflation is not necessarily a bad thing. You know, of course, you have in your mind the picture of the Republic of Weimar with a guy with a big bag of money going, or the carrot going to buy a bread, and something like that happened to me in Venezuela, which is a country where inflation has been out of control for many years. It happened to me once to go there in Caracas and buy a coffee, and I had a stack of cash like this just to buy a cup of coffee. So of course you don't want to get to that extreme, you don't want to go into deflation either. So that's why interest rates are so important, to cut interest rate at the right moment. But the interest rate cut or rise is for government and central bank a sort of ordinary measure to control inflation and to regulate the economic cycles in a way that we can have, you know, those waves of growth and let's say recession. We can smooth these curves using interest rate. But we have another measure, which is the quantitative easing, which is an extraordinary measure. Now we're sort of getting used to hear these terms, and because in the last years, in the last, let's say 20 years, we had 2-3 economic crises. I can remember the one of 2008 due to the real estate, the mortgage bubble in the US, that then arrived in Europe as well. And then we had COVID. So in these peculiar moments, the central banks had to use the quantitative easing. What does it mean? Basically, government, they have a balance sheet, exactly like any company in the market. So what they can do is use that balance sheet, that expanding capacity, to help countries and then banks to finance themselves. In particular, for example, in Europe or also in the States, we have either the BCE or the Fed purchasing the either mortgage-backed security or the treasury bonds issued by government that otherwise will be sold on the secondary market. So when you sell your debt, it's like saying, okay guys, I'm here, I need money, who is going to lend me this money? And of course, the more reliable you are, the more you will have people willing to borrow you money. The less reliable you are, the less likely it will be for you to find finance. In moment of crisis, nobody wants to lend money to anybody because there's no trust. So if central government starts buying those mortgage-backed securities and those bonds, of course the government get financed more easily, and they can then lend money to the central banks. Then they can lend money, of course, to consumers and companies. So it's a measure again to increase the circulating money in the world, in the economy. And that is why, you know, this ability for a country to finance themselves is very important, also to regulate, for example, import and export, but also to measure the temperature of trust of your country. In Italy, we're used to the spread. We always constantly check ourselves versus the Germans. We always want to see the Buoni del Tesoro, the BTP, versus the Bund bonds, so that we know, because for Germany, for us, is the super reliable top grade, the investment grade bonds, while Italy is less reliable. So we want to see how close that we get to finance, so that we can to Germany so that we can compete with Germany in export, because otherwise if you finance yourself at a much more expensive rate, it becomes very hard for you to compete. So the same reason, a slight change in those interest rates can have a huge impact. Just think about the mortgage. If you have your house mortgage on a variable rate, an increase in those interest rates, and now they are hurting you a lot. This change in the price of the houses immediately is impacting your daily cash flow. It can be, and it impacts also the way you want to invest. I'm thinking, I want to open a parenthesis. Think if you're a money manager right now, it could be very difficult for you to understand how can you actually save and protect the money of your customers. All the money managers, or most of the money managers at the moment, they are suffering. How do they typically build a portfolio? There is a large part in bonds, another part which is like 70 to 80%, then 20, 50, 30% in stocks, a part in commodities, normally that will help you in case of high inflation like this case. But if you had a large part of your portfolio invested in bonds, in the bond market, you've been suffering, because with interest rates going up, your bonds are worth less, so you're losing on the core part of your portfolio that in theory should be the safest part. That is going down. Stock exchange, of course, is going down. So the only thing that is helping your portfolio to perform a bit less is probably the commodity part, if you picked up the right commodities. So it's very interesting to see how those changes in the government policies actually impact everything from economy, investment, the everyday life of people, because now the impact of these higher interest rates is that for you, for everybody, it will be more difficult to have that extra money that you can use to buy crypto, to buy your Patek Philippe, your extra boat, etc. So of course you don't have that extra boat, so in theory less demand should help prices go down. Going back to us, what we have seen in moments of global economic crisis like the one we lived, the two main means that government have at disposal to try and help us, the economy to recover, are of course the interest rate cut, or ease out, or the quantitative easing, so the balance sheet. So what we can do at the moment is, of course, what governments are doing are rising interest rates, which there is still a bit the doubt of how much can we go up on those interest rates if the government actually have a model in mind to keep this under control, and of course shrinking the balance sheet, which means going towards quantitative tightening instead of quantitative easing. Of course, COVID arrived in a moment in which we were slowly going up on quantitative easing, and we were trying to rise up back the interest rates, because you want to have a certain allowance, a certain amount of interest rates going on, so that they can be cut at the right moment. But of course, is that COVID struck, so the governments had to take extraordinary measures. So now we are, these two hyper inflationary measures, so low interest rates and quantitative easing, had to be winded back, and at the same time we had a third element of surprise, which of course was the war in Ukraine. The Russia-Ukraine war triggered a sort of other problematics. First of all, supply of gas, which is a very high inflationary commodity, because of course from gas we derive power, and of course heating. We have oil, we have gasoline, we have jet, so moving will become more expensive, grain will become more expensive, coal, all the old pattern of trading of raw materials and commodities with high inflationary impact has changed. So that is really creating a sort of hyperbolic effect on inflation. Think about how those patterns can also influence your trading, how that can influence, for example, the euro dollar. The US, they're exporting oil, they're exporting gas, so of course the price of goods, their balance sheet is growing because they're exporting and getting in a lot more money. They're rising interest rates at a pattern which is much faster than Europe, so that's why dollar went up so much and so quickly. Now the latest data on inflation looks like it's a bit slowing down in the US while it's still going up in Europe, so Europe will catch up on interest rates, so that is why we're sort of rebalancing towards the par, the euro versus the dollar. There is one thing which I didn't mention so far, which is also interesting. One other way to reduce inflation, of course, we as consumer, we can try to avoid to control our let's say consumption, but let's say that also private companies can try and let's say maybe reduce a tiny bit their margin to try, you know, and help us, the economy and the consumers. But what they're doing instead is try to maintain their margin, just trying to get a back-to-back of their profit or their increased cost of raw materials and goods back-to-back to the customer. So my gasoline goes up, my grain goes up, and so I just increase the price. And of course, you know, consumers which are struggling and counting their money say, okay, if you increase the price, then I'm not gonna buy that product anymore. I'm gonna switch to something which is more economic. So the trick, the marketing trick, is what is now being called shrinkflation, which means that the packaging remains the same, they're just reducing the quantity. This is a typical package of pasta in Italy, very nice and famous brand. Normally in Italy, when you buy pasta, you buy them in 500 grams. It's a typical format. I just noticed that the size of this package is the same, but the content, it went down from 500 grams to 400 grams. So you know, I'm pretty sure you see plenty of videos on the web where everyone is doing that to try and counter and tackle inflation. I'm not sure that is the best way, is in the best interest of everybody to just, you know, try to maintain your profit level also when the economic conditions to maintain that profit level are not there. So guys, all in all, there's not much we can do about it. You are living, of course, in an interesting time where unless you're lucky enough to have invested in certain commodities, you'll probably be struggling. I'm in a way lucky enough to be trading in a market which is linked to commodities, a commodity service. So for me, it's a good market because it's a market with high volatility, which could lead to high opportunities if you are trading. That being said, try to, you know, hang in there, reduce your consumption, and let's monitor and see if you know, our central governments have the right tools, as they do have them in their hands, to get us to a nice slope towards this recession and hard times, back to a nice recovery economy, possibly during the next years. That's all for today. I wish you a very nice evening or whatever day, and as usual, please keep your leverage low and trade safely. Bye, ciao.